The US stock market just had its worst month since March 2020. In April, the S&P dropped 8.8%, the Dow 4.9%, and the Nasdaq 13.3%. Worst month since 2008. My long-term portfolio is down 29%. Why are stocks acting as if we are in crisis? The market has bleaker growth prospects. The primary headwind for growth, of course, is our beloved Fed's plan to hike interest rates in order to cool crazy high inflation. This has especially been painful for high-flying tech companies, which become less attractive as interest rates move higher. Then we have the supply chain bottlenecks. With China locking down cities, American companies whose products are made in China aren't able to fulfill orders. Apple, in their earnings, said that it would face up to $8 billion in losses due to restrictions in Shanghai. Top that with geopolitical unrest, Ukraine-Russia war. Companies are facing challenges across every sector. The question in my mind is, what is my plan for the rest of the year and beyond? Hey guys, welcome to Think Finance. My name is Raj and this channel is all things money. Stocks have only gone south in 2022. S&P is in correction while tech is in a bear market. Indeed, market is playing in this range for now and refuses to turn around meaningfully. Logic says the best time to buy stocks is when they are down big. We are down big, but are we down enough? In this video, I want to share some data points that will hopefully help us make some decisions. GDP shrunk last quarter. Will we encounter a recession? Maybe. Let's assume we hit a recession. In one of my recent videos, I talked about how you should expect pain heading into one. Looking at past recessions, on average, the stock market has fallen 32% from peak to trough, heading into a recession. During COVID, S&P dropped 34%. On average, pullbacks lasted 381 days. But here is a positive data point. 6 months after the start of a recession, markets were up average 7%, 82% of times. 12 months in and markets were up 16%, 91% of times, and 20%, 82% of times 24 months in. Start of recession is when NBAR or National Bureau of Economic Research officially announces a recession. This is typically when NBAR sees significant drop in economic activities, usually when GDP goes negative back-to-back quarters. S&P is in correction, but tech is in a bear market. Some fun facts about bear market. Bear markets are normal. There have been 26 bear markets in the S&P 500 index since 1928. Bear markets tend to be short-lived. The average length of a bear market is 11.3 months with average cumulative drop of 32%. A bear market doesn't necessarily indicate a recession. There have been 26 bear markets since 1928, but only 15 recessions during that time. While we can't know exactly if or when the market will recover, stocks historically have recovered sharply following a downturn. Just for kicks, let's assume you bought Nasdaq every time it encountered a bear market. What would your return be? As you can see, the average return is quite good, especially when you consider the fact that many of these bear markets went much deeper than 20%. Buying stocks when they're on sale tends to be a winning strategy over the long run. Tensions between Russia and Ukraine has also been a cause of worry for the market. If you look at the data, historic events has caused some short-term drops, but not by a lot. S&P dropped an average 5%, bottomed within 19 days, and fully recovered within 43 days on an average. The average 6-month gains following 28 such events was 2.3%. We keep hearing that the Fed is behind the curve and it needs to do more to manage inflation. For the next year, we will be in a rising interest rate environment. Investigating last 4 Fed tightening cycles, S&P 500 had a positive 12-month return following the first rate hike, averaging 7.13%. More in this video. Sentiment in the market is crazy bearish these days. Looking at data from AAII Investor Sentiment Survey, bearish sentiment is at a 52-week high. Also, the CNN Fear Gauge Index is about to hit extreme fear. Not there yet, but getting there. Fed tightening, geopolitical noise, recession fears, and bleaker growth prospects has pushed S&P into correction and tech in a bear market. Everything out there is telling us to sell and run. If history is any guide, buying stocks in a bear market tends to be a winning strategy. Looking from a recession point of view, historically, the best time to buy stocks is when the NABAR announces the start of a recession. Remember, the Bureau lags. It takes NABAR at least 6 months to determine if a recession has started. Occasionally, it takes longer. Given the average recession lasts 11 months, often by the time the Bureau has figured out the start of a recession, it's often pretty close to the end. Markets are forward-looking. Key takeaway? Start doing some serious buying when recession is officially declared. With that said, these are just data points. No one can tell you when we will bottom. I've been buying on the way down. I keep adding at key thresholds when markets drop 10%, 20%, and 30%. And in between, do some trading via options. All I know is that the best time to invest is when markets are low. And not staying invested when market recovers can cost us big. Take a longer term approach and you'll be fine. Thanks for watching. Happy investing. Until next time, peace.